The concepts and models that I'm going to be providing, starting with this one here, 3 all the way up to the 12th one, will be in this format. It's going to be relying heavily on your understanding of what you've already learned in the mentorship. I'm not rehashing everything. I'm not spelling it out to the last letter. Originally, I wanted to do that, but just look around on Twitter and on social media and YouTube. You can see there's a lot of folks now in the business of teaching my stuff. So whether they're using it under the guise of the free content or worse, what's coming from the mentorship. I got 6 new people I got to start tracking, and it's just become disheartening, actually, because, yeah, I knew this was going to happen. I mean, everybody knew it was going to happen, but I'm not going to provide a PDF and a video where they can just, mimic that and be in business, teaching, one model or more than that. So this model will be teaching the swing trading ICT approach, or one method of doing so. And its primary focus is going to be attacking daily liquidity pools. Okay, so that's going to be the draw that we're using for this model. And as you'll see with the remainder of the models that's going to be shared, we're focusing again on one specific criteria as our justification, if you will, for looking for a setup. And then we're going to look for the actual ingredients that go behind the scenes that make that setup viable. Okay, so let's continue on. Okay, so we're looking at the swing trading model. Again, the draw on liquidity, what we're anticipating in terms of why the price should be moving in a direction one-sided, higher or lower. It's going to be based on daily liquidity pools. Okay, but the stage is going to be set for that whole business, okay, because there's going to be liquidity pools always in the chart. But the underlying condition that sets up the setup is the stage. Okay, and that stage is going to be the COT hedging program. Okay, so we're looking at the last 12 months of Commitment of Traders Report data on just commercial traders only, getting its highest high and its lowest low in terms of their net position, dividing that range in half. If it's above the midpoint of it, we're going to be looking at that as a bullish commercial buy program, and or if it's below that midpoint of that last 12-month range, we will be assuming that it is a commercial sell model. Okay, if we have that stage and we have a daily liquidity pool on the daily chart, okay, we're going to be looking at that as our setup, and our entry pattern to trade this model is going to be the optimal trade entry. Okay, so now this is what I'm ringing in now, because this, for the lack of better terms here, it's going to accomplish the method. But if I shared this, for instance, on Twitter, I'm confident that this would not mean very much to the lay audience. Now, for a person that's gone through all 12 months of the mentorships and studied the content, if you look at this as I explain it, you'll know exactly where to go into the mentorship content and dig up more information on how those specific components are amplified by using this whole concept. Now, this is a conceptual idea shown in a graphic form. So in other words, this is the entire model shown in picture form. Okay, so when you think of this trading model, this is how I interpret it. Okay, this is how I internalize it. This is how I see it in my head, and how I go into the price action to hunt the setups itself. Okay, so along the top, you can see it's the COT hedge program, and I'm giving you a graphic depiction of 12 months. So in other words, if today we were looking at a particular market, and this is what we would see, the highest high and the lowest low of the range, if it has broken the previous low in the last 12 months, then obviously we extend the range to the lowest point that has most recently been created. So that would be seen in this example here. So I'm throwing that in as an actual bonus because I didn't mention it too much during the mentorship because people were coming and going, and I didn't want to give a lot of the information out for people just going to hang around for 1 or 2 months, in the latter stages and then leave. So when we have our COT hedge program, okay, so we've modified the COT net trader position chart as taught in the mentorship. If it's showing that the commercials are bearish relative to that concept, and the daily chart shows a liquidity pool, in other words, equal lows or a ideal low that would have a lot of sell stop liquidity below it. If that criteria is there, we would hunt optimal trade entries to go short, targeting a run on those sell stops. Now the focus is we're going to be anticipating the monthly chart or the monthly range to provide us the swing model. Okay, so the time frame we're using to facilitate the trade is on a monthly chart. So the candle that's being depicted here, we're anticipating the down movement of a monthly candle. While this candle shows it closing near the low, we do not require it to close down there. We just want the range to expand down. Also notice that at the end and a new beginning of a new month, we're using the IPTA data ranges. A lot of flack has been said about this, and it's just simply a measure of going back the last 20 days, the last 40 days, or last 60 days. In other words, what's the price action in the last 3 months or a quarterly effect. Looking back at either one of those intervals, if we see a liquidity pool, that's the one we're going to be targeting if this criteria with the COT hedge program is in effect. Okay, so let's move on. Now obviously everything can be reversed. Here, this is the concept in graphic form, just reversed. If the COT hedge program is showing in the last 12 months commercials are a net buyer, and the price action on a daily chart shows a equal high or a very clear intermediate term high where buy stops will be resting for liquidity pool, we will be targeting that, and we'll be looking back 20 to 40 to 60 days from the new month start, and we'll be framing that as our context for the trade. But again, the time frame we're focusing on is we're looking for the monthly candle to expand higher in this condition here. Obviously, you can see when the COT data for the commercials, if it's showing them as a net buyer, and the criteria is enforced with the daily chart showing a liquidity pool resting above equal highs or an ideal intermediate term high, we will be looking for that as our draw on liquidity. Again, we do not require the monthly candle to close near the tie. We just want the range to expand to allow us an opportunity to find a setup to be profitable. Okay, and again, this is the monthly range. We're going to be looking for the market to expand up on bullish months to a buy stop liquidity pool and or run equal highs on the daily chart. And for the monthly range when bearish, we're going to be looking for a run to equal lows on the daily chart and the sell stop liquidity pool resting below an old low. Okay, so this is what we have here. Our example for this model is going to be on the Canadian dollar. You'll remember this actually because we covered it during public analysis. Really, I did it all on Twitter, and everything's been shared there. You can still go back and look at it. We really tracked this one online publicly. So again, this is Canadian dollar. So when we're looking at the Forex market, everything has to be reversed because the pair that's associated for Canadian dollar that we trade against the dollar is dollar CAD. So everything we see in the futures contract, which is being shown here, has to be reversed because it's an inverse relationship when it's in the Forex pair dollar CAD. Okay, the arrow is just depicting the point at which we're focusing on for the setup. And I'm giving you the red line here highlighted to give us the entire total range of the last 12 months at the time of that arrow. Okay, so you can see we're below the midpoint. So commercials are in a net short position relative to the 12-month range. So we would be looking for a liquidity pool in the form of equal lows on the Canadian dollar futures contract or equal highs for the dollar CAD pair. Okay, so the logic behind this is the monthly range, when it's bullish, will likely see a strong impulsive move higher, and inside that monthly range or candle, there are typically 4 weekly ranges or candles. We're going to be seeking the range inside the monthly range before the candle completes and a new monthly range begins. That is to say, we want one or more of the 4 weeks that construct a monthly range to profit. Okay, you see the chart here. That little tiny candle in here that's being delineated with the arrows, that's all this setup is focusing on for this particular example here. Now, obviously, everyone wants to see the big move off this monthly chart, and that's an entirely different type of setup. I'm giving you a model here. You don't need the biggest moves, okay? And you'll see that this is actually very sufficient. Zooming in on a weekly chart, this is the entire move that will be captured with this model in hindsight as an example, but again, everything has been mentioned in Twitter. And on the daily chart, this is the move that it shows relative to the pattern and model that we're teaching here. And we're going to expand this a little bit bigger. What we're looking at is that move there. Now you're probably saying, well, why couldn't this just be a short-term trade, or why can't it just be a one-shot, one-kill? It can, and like I said in the mentorship, a lot of the setups can at times overlap, but we don't know if it's going to continue higher or lower when we're taking the trades. So we're just framing the idea here to give us the context to work within in terms of a consistent model. Okay, you can see here the IPTA data range, new month starting here, March 1st, 2018. We're looking back 60 days. If the data look back, takes us back right to those equal highs. And then we have a 20-day cast forward. So we're anticipating a potential move to complete and or a new setup to start 20 days after the beginning of the trading month at March 1st. Okay, you can see the equal highs, which is a buy stop liquidity pool. Now price had already ran initially there and started to sell off, but we're looking at it as a potential continuation and anticipating it to wipe out a little bit more of that liquidity, go a little bit deeper into that. So this is going to be our optimal trade entry. Now notice I'm showing here March 1st. And now think of it like we teach the intraday patterns where we have a Judas swing. There is a kind of like a pseudo Judas swing here on the monthly. Okay, if you look at the opening price on March 1st, price comes back down after initially rallying. We don't want to see that. We're focusing on movements at the open at the beginning of the month or below it. Okay, so when price trades down below that opening price, and I already know what the question is going to be is what's the opening price? As soon as we start a new month at the beginning of the Asian session, first trading day of the month, that's the opening price. Okay, we'll use that one. And if you want to get fancy, you can use the opening price at midnight on the first trading day of the new month. I use both of those, and I'll refer to it as the first week of trading transpires. But price, after making an initial rally higher, trades down into the optimal trade entry, providing an opportunity to buy. And also notice it takes out an initial swing low that you can see right at the 70.5 level or the OTE level on the fib. It trades just below that a little bit, and then that's the buy. Okay, that's the pattern, that's the setup you're looking for. Now this is a 4-hour chart. You don't need to go anything lower than that, but I'm going to show you how you can fine tune it if you want to get a tighter stop in this. Obviously, you know what your stop loss is going to have to be by using the mentorship and using optimal trade entry and all the stop loss placement things. I'm not going to include all that here because to do that, I'm basically giving you an entire mentorship in one video. and I'm not doing that for people that are, sharing information now. I'm not making it easy for them, let's put it that way. But if you studied, you know the things in the mentorship, or you know where to find them because of the topic titles, obviously it makes it a lot easier. Now you're probably asking yourself, why am I using that anchor point for the fib? Well, we're going to drop down into the hourly chart and you'll see why. You can clearly see that's a swing low. All I did was use the transition from a 4-hour down to an hourly chart, and you can see that fib is overlaid here. And you can see a very clear swing down into the optimal trade entry, and now we're including the hourly because it's going to be day of week. So if we're buying, okay, and we're swing trading, we want to be doing what? Trying to buy on a Monday, Tuesday, or Wednesday. If we're selling short and we're bearish, what are we going to be doing? Looking to sell short on Monday, Tuesday, or Wednesday. Okay, and the kill zones are a London Open and or New York Open primarily. Okay, so now what if you want to reduce the amount of risk? You don't want to take that entry at the optimal trade entry and have to use a stop loss, down at below the 127.40 level. That's a pretty big stop loss. In some day traders' minds, or certainly a scalper, they would think that's incredibly too large. I can't do that. If you take the optimal trade entry that is here from the afternoon low on that Monday and expand it up into the initial high of the day on Tuesday, right before they had the big move up and rally, you'll see that as another optimal trade entry there. And you can use a stop loss just below the afternoon low on Monday of that particular week. So now you can reduce the amount of risk and still be able to take this as a swing trade. Okay, so you can get a much larger R multiple for this particular setup. Now notice that also on the hourly chart, you can see that there is a liquidity pool with the previous week, March 5th, 6th, and 7th. We have equal highs there. That's what we're targeting. That's a daily liquidity pool. And it's also an overlap of the two fibs. Notice what happens here. We see that target one line on the initial fib on the larger price swing and another fib level from the shorter price swing. Now you're probably asking, what's all those extra lines up there? Okay, I want you to write this down in your notepad. Okay, I'm not providing it on the screen because I don't want people just having access to a PDF. If you're going to steal my stuff and you're going to share it, you're going to have to work for it too. So the levels I have on here for the fib is negative 27, negative 68, negative 127, negative 168, 2 even, okay, 2.0, and then 2.27, these are all negative numbers, and then negative 268, negative 3, negative 3 decimal point 27, negative 3 decimal point 68, negative 4.0, negative 4.27, negative 4.68, and negative 5.0. Okay, and you'll get these lines on your dollar CAD chart. And notice that there's a connection or overlapping of those two levels there. That would be your target. Now you do not get that last little piece movement up, but it's not necessary. Okay, and you can see what happened immediately after that. It really falls out of bed and comes back down to the original optimal trade entry. Now, your risk on the trade is completely up to you, and that's how I'm going to be teaching the rest of these concepts, because we talked about risk management, we talked about leverage in the mentorship, we know where the stop should be, and now looking at target 2, since it's a swing trade, okay, on the second fib, that target 2 would be your first scaling. So if you're going to take something out, you would take something there, and then you would do it at every full incremental number. In other words, you would take some at like 2.0, negative 2.0 on the fib, negative 3.0 on the fib, negative 4.0 on the fib. Or if you want to go a little bit more and try to get a little bit more juice out of the lemon, you can use the 3.27. These are all, again, negative numbers. The reason why it's a negative number is because as the fib goes higher, notice the lowest number is 100. So as we go higher, they're dropping in number. So once we get to that top line, it's the 0 line in fib. So anything higher than that has to be a negative number. So you can do like negative 2.27, and then if it goes to negative 3.27, you can take something off there. All of that's customizable. You can do all those types of things yourself, but personally, you don't want to just take it at the fib level. You want to take them off when there's an old high. Okay, the first target 2 on the second fib, that's just a take something off to reward yourself. That cookie reward to make the trader feel good. So that way, if the trade does fizzle out, at least you took something off of it, got a pound of flesh. But notice how if you start looking at all the fibs that start to expand past that second Fibonacci level of target 2, start looking at those price swings to the left right before we get to those equal highs at the buy stops. If there's a fib that overlaps with a run above those short-term highs, as you can see right here at this one, okay, above this high, we have this fib, so we can take that as an area of scaling, take something off, and obviously take something off that gets right here, right at that level, and then look for the combination of the two fibs blend together, and you would have a really handsome setup, and also an overlapping of institutional level 130.80 right in here. So that's going to be this one for price action model number 3. Everything is reversed for short selling. Study it. Everything's in the mentorship. I did not teach anything new here except for just an expansion on the fib. And again, all the levels are in negative, so it's a negative or dash or hyphen, and then you enter the numbers. Okay, folks, welcome back. All right, so we're at our update for model number 3 for swing trading, and it's April 19, 2019. Happy Passover. So again, this model is specifically dealing with swing trading, which is an intermediate term style to short term style. I'm not going to rehash everything that was covered in this video here. You guys can obviously, and you should be watching it again before watching this video. Otherwise, it's going to feel fragmented because it's been such a while since we revisited this model. Its focus is primarily on, and this is the reason why I did the outline like this, because it will allow me to come back to it each time we do a new video. So again, the models for folks that don't have the ability or the capacity to day trade or short-term intraday trade scalping and need a little bit more oomph in terms of movement because of their time constraints or their personality limitations, do not allow for them to be a very small short-term trader. So they're looking for larger moves, primarily looking at the daily chart. It doesn't mean that we're not able to use the intraday components and concepts to help reduce the risk, because that's exactly what you should be doing. Not necessary, not required, but it helps. And that's the reason why we do 12 different models, because they will all complement. You'll see this at the end of all the presentation. When I'm done, when I say, okay, we are done talking about these models, and whatever else direction I take the mentorship after that, it will be very easy for you to see how they interlock and interconnect with one another. They overlap beautifully, which is what gives me the ability to go in any time frame and trade. Now, admittedly, I don't like to do long-term or intermediate-term swing trading. It doesn't fit my personality. It doesn't mean that I can't point them out to you so you can pay attention to them. It just means that I personally don't really participate in them because my mind can be changed on a whim. And I'm very short-term, attention span, that type of thing. So I like to be where I'm my best, and you guys can see that on Twitter. I'm a day trader at best. With the higher time frame, short-term, one shot, one kill, the weekly range. So this model, we like to look at any pair, doesn't make a difference, any market. It can be a London or New York kill zone, and the trade objectives are going to be 100 to 300 pips on average. Sometimes it can be a lot more than that if there's a lot of things going behind it, like seasonal tendency, market structure. If it's a commodity, it may be a premium market where everything is backwards. in terms of the delivery months. It's now more expensive in the nearby months than it is the further months out. So the trade frequency generally will be 1 to 2 times per month. And the reason why that is the case, because we're focusing on, as the lesson, the presentation initially outlined, we're looking for that monthly candle to expand higher or lower. Okay, so if we have that prognostication behind the analysis suggesting that we're probably going to be moving higher or lower depending upon the market structure and the technicals at the time, because everything is relative to that. If we know that our tools and our concepts and our analysis are leading to the high probability that a prolonged move will see price advance higher or lower relative to the monthly chart, we're basically predicting the monthly candles, bullishness or bearishness. Now, because of that monthly candle, it's comprised of generally 4 weeks. So if we capture 1 week out of that month with a swing trade, we're successful. And it does not matter if that monthly candle closes near the high or bullishly. That's not the point. The point is we're trading inside of the order flow. And when the expansion occurs, it's seeking buy-side liquidity above the marketplace, or it's seeking sell-side liquidity below the marketplace. And all we're trying to do is capitalize on that displacement in price relative to the monthly range. So don't think that we have to have the monthly close in our favor. Many times, my analysis lent very well to the directional bias for the trade, but sometimes the candle on the monthly basis actually reversed. And there's nothing wrong with that, because the basis of what we're trading is the liquidity or the draw on liquidity above or below the marketplace. So when we have these things in mind to build a model that builds a bias, it builds a setup, a framework, it's all based on that monthly expansion, higher or lower. Okay, so swing trading requires that all the time. That's the common denominator. That's the foundation, if you will, to solid swing trading. You don't see that in books. You don't get that from other people that are trying to teach swing trading, because they're just going in there looking for things, at the right now daily chart or less, and that doesn't bode well for high probability. You guys see, I don't lose a whole lot, and it's based on framing setups that would deem them to be high probability. So for swing trading, you have to have the underlying direction of that monthly candle that's to form next. That has to be bullish or bearish in your analysis. And if it's not, and you can't clearly ascertain what directional bias it is for that monthly candle that's going to form next, then you don't have a high probability condition. So you need to leave that model and go down to a lower time frame or model, which would be short-term trading. But again, that's outside the scope, but I just want to put that in here because you can include that for your notes. We'll talk about that as we go into other models. And again, it's not focused on any one particular day of the week. So it's very fluid. It allows a lot of flexibility. So we're going to go over to the Canadian dollar. All right, so we're looking at the Canadian dollar. Now, this is the futures market. Okay, so when we look at the futures market, we have to remember, if we're trading Forex, and I'm going to present this on both sides of the coin here. If we are a futures trader, okay, and we're paper trading or demo trading the Canadian dollar futures market, if we're looking for bearish prices on the futures contract for the Canadian dollar, that's going to be the opposite direction to what we'd expect to see happen in the dollar-CAD pair, because the first currency in the pair of dollar-CAD is the dollar. So when it moves up, that's the same thing as saying that the Canadian dollar futures market is going lower, and vice versa. Okay, so it's just make sure that you are aware of that and it doesn't confuse you. The line that's down here, okay, is the commercials, And what I've done is eliminated all the other small specs and large funds. And we're only focusing on the commercials. Okay, and you can do that on bar chart if you use the technical chart. And I'll show you what that one is, the link. Not the technical chart, I said that wrong, I'm sorry. The interactive chart. Usually I show you with the technical chart, but if you want to remove the large speculators and the small speculators and just show the commercials, you would just go into the studies here. And I have the little eyeball toggled, so it's got a little line in it, and only the commercials are showing the eyeball. If you want just the large specs to show up, you would do that. Okay, but I'm not going to do that. That's what we have here. We're applying that, and what we have is the market showing a willingness to want to go lower, obviously. And if we look at how price has worked lower all through here. All right, so if we look at just the line itself from a traditional view or perspective on commitment traders, the zero basis line, this would look bullish. Okay, this is what's always confusing people with COT. It gets so frustrating that you're like, what is this? If we look at what they're saying relative to this chart here, or as commitment traders data analysis that was taught by Larry Williams back in his How I Made $1 Million Trading Commodities Last Year book, classic. You need to have it in your library if you don't have it. He talked about how this was the underlying framework. And sometimes that's true, and most times it's not. So what we do for this model, number 3, is we use the hedging program, okay, which is we take the last 6 months, the last 12 months, the last 2 years, or last 4 years, depending upon what time frame you're looking at. But because we're swing trading, you can do this with the last 6 months, but we're sticking to the rules of the model number 3, original presentation, the last 12 months. So if we're looking at the November time period, in the fall, December time, we would go back about a full year, which is here, and we get the lowest reading on the commercials and the highest reading, and we split that in half. Okay, that's what we're looking for. And when we do that, it gives us a range. And that range will define whether or not we are really above or below based on their yearly maximum buying and maximum selling or hedging on both extremes. Once we have that range, we split it in half. Okay, so when we do that, it gives us a real clear depiction of what is underlying in terms of their bullishness or bearishness, because it gives us a boundary of what their highest point of hedging long and lowest point of hedging short. They're always doing buying and selling all day, every day. But the bulk or their net position is what we're tracking. So what I do is I look at the range, and this is obviously, like I mentioned in the mentorship, it's completely unique to me. And what it helps me do is define where we are in the real extremes. This perspective, I'm convinced since everyone started doing it, the data gets skewed. So by removing the perspective of looking at like this, whether it's above or below the zero line, I create my own zero line by taking the highest range and the lowest range of the commercials, net positions, and I treat it like an overbought, oversold. Then I split that in half, that range. If we're above or below that new zero line, it gives us a clear, at least it gives me a clear idea of whether I should be bullish or bearish on that market. So once you do that, you end up with this. Now, you see me do this in mentorship. I'm going to do this again because otherwise this video will be way, way long, and I don't want it to be way, way long. So this is the chart. All I did was copy it and drop it into Paint, okay? And most computers have this. It's a free little app. It's inside. And what I do is I get the rectangle right here, and I draw it over top of the highest point and the lowest point right here. And then I turn on view here, and I put the ruler and the grid lines on. And it helps me see the boxes that will represent the highest and the lowest range. And I just zoom in and I count the number of boxes. And then once I get a determination of how many boxes it is, I just divide that in half. Then I count down from the top or count up from the bottom to that number, which would be half of the range. And then I would draw a horizontal line across that, and it gives me a new zero basis line. Now notice mine is up here. Okay, this is my zero basis line, which is higher than the zero line based on the traditional view of commitment traders' net position charts. So with this information, then I just go back and color in for you. I don't need to do this personally, but I do it for you. I go in and I take the little paint bucket here and I color in all the commercial line below the zero line. When it gets back above, I color it green, and when it's below, it's red. Okay, and that's what I'm seeing when I look at just this chart. When I look at that, I already know I can rough it visually where the midpoint is on the range. This is what you end up seeing. So all this time period here, their hedging was net long by a traditional analysis perspective using commitment traders, but it really is long based on the hedging program that I've used here by interpreting the data just slightly different. So I'm convinced that there's really no way for them to mess this up unless they just start to really delay the COT information. And if they do that, it'll just mean that there'll be more deviations in terms of their net holdings each time there's an update. So it really is, it's not going to change anything. It's just going to actually make it even better for me because I'll see them a lot sooner than it takes with this. It's a long-term approach to using quote-unquote fundamental data. So they're long in here, great. Okay, you can see all of the buying opportunities that took place. Bullish order block, it retrades back into it, rallies higher. Okay, we have a bullish order block in here, price trades down into it, heavy net long, buy, takes off. Okay, but notice what we have here. From October to December, we have the commercials in the hedging program, ICT version, bearish. And that's reflected with that movement lower here. And it wasn't until we got to this price point here towards the last week or so of December where we would start to see the commercials go long. So now these two camps, whether they're bearish or bullish, are changing. Okay, there's a changing in the tide, if you will, or the fundamentals. Now that doesn't mean it's time to get long Canadian dollar or short dollar CAD. It just means that they're now starting to have a larger degree of buying. They're hedging. It's not a turning point, okay? But what we see here all through this period from October through December, every time price rallies up to a up-close candle or bearish order block, there's an opportunity to sell short beautifully. Market rallies back up into a bearish order block, sells off beautifully. Now again, this is a daily chart, so this is all swing trades. Here's a bullish candle here, bearish order block. Price rallies right back up into it. Boom. With the commercials net short. But you don't see that because they're above the zero line relative to a retail perspective looking at it. They're not going to see commitment traders as bearish there. We do. Okay? And with that in there and institutional order flow, you have two of the strongest things in my repertoire working for you. We were expecting weakness in Canadian dollar. Go back and look at all the videos. You'll see all that stuff. If we are a commodity trader, okay, if we're paper trading, if you will, there's several things in here you could have done. And this is what you do going forward when you practice. You could use the order block, okay, use the order block and buy a put option or not really buy it, but paper trade the price. As price rallies up into that order block, that's essentially the 76.50 level, 77. You can do a 77 put. And when price was rallying up into that order block here, or when it was rallying back up into the order block here, you can look at the 77 put, you can look at the 76 put, okay, and and they'll have an opportunity for you to paper trade the option. Or you can just simply paper trade or demo trade the outright short of the Canadian dollar futures market. We're going to focus on October to December for the Forex market. That means when the Canadian dollar for the commercial hedging program using the COT data here, when we have this bearish here, that's going to be the opposite for the dollar CAD pair. It's going to be bullish. So remember, from October through December, it's bullish dollar CAD because it's bearish Canadian futures. Okay. With that said, we're going to move over into the dollar CAD, and I'm going to start with the monthly chart here. We have down close candles here, which is a bullish order block. We have a small little candle body here with a wick that goes in that basically rebalances this volume imbalance. That stuff works on a monthly chart? Hello. This imbalance here, volume imbalance, there's no candle body there, just a wick. And it only goes up through with this candle here. And it comes down, rebalances. So there's two passes it takes to get in here and fill that in. It does so here. Okay, beautiful return to an order block there. By itself, that's enough. That's this imbalance, fair value gap or void, that's what makes order blocks high probability. Otherwise, it's just a down close candle. We have the order block that starts with both consecutive down close candles. When we trade above it, this candle here, when we trade above it, we now have a valid order block for this level here. Otherwise, until we break above this in a meaningful way, it's not meaningful here because we have a wick and we close the body here. That means we have to spend a little bit more time inside the order block. What's it going to go? It's going to go right down here and to tend to this volume imbalance. Okay, so we're not going to talk about that. I just threw it in here for extra credit and no extra charge. But we have the order block that's extended out in here, right in here, as price was trading down in this candle. When that candle closed, that very day, the last trading day of that month, okay, of September 2018, you go into it with the expectation in October, we're going to anticipate an up candle. Now again, these are monthly candles, so we're anticipating a monthly candle or a range expansion on the upside beginning in October, okay? So with that said, what are we aiming for? Well, we have this old high right here. And we also have these old equal highs relative. This is our draw on liquidity, this high here. So we know that if this is a monthly chart, this level right here may be something else on a weekly chart. Or it may be something on a daily chart of greater significance. And by that, I mean equal highs, like the original number 3 model presentation described. So in this area here that's shaded, this is going to represent that October through December bullish commitment of traders. Again, relative to this here, it's just opposite, okay? We're just reversing that whole viewpoint. Okay, I'm dropping down into a weekly chart here. And now you can see even the last down close candle, extend that out in time, beautiful bullish order block, hits it right there, okay? All we need is the direction of the monthly expansion. Each week, we have the possibility of taking one shot, one kill in that direction, or we get in sync with this market move and we hold it over several weeks. Now, that high on the monthly chart, look what it becomes on a weekly. Equal highs. You see that?
Now this just happened to form in the very market that we talked about in the original presentation, but now we're looking at things on the opposite. We were bearish back then. We're looking at bullishness on the dollar CAD. So if we're looking at these equal highs, that's going to be a draw on liquidity. Trading into a weekly order block, we're expecting the monthly order block to send price higher. So if that's the case, and this is when we're expecting that COT data, all through this period, COT from the hedging perspective that I taught you, and just showed you again with this chart here, it's all bearish in the futures contract, but it's bullish all through here. Okay, in other words, it looks like this. If we frame that out with vertical lines, this is the period at which that same COT chart here was bearish for Canadian dollar. It's all bullish here, and look at the beautiful delivery of price. Now, if that doesn't get you excited, okay, if that does not get you so amped up, learning what makes these markets move like this, you don't see this stuff in retail books, folks. You just don't do it. Larry Williams ain't doing this. Okay, I'm going to tell you right now, he's not doing this. No one's doing this but the ICT click. So I want you to really appreciate it, because the amount of detail and confidence that it gives you, knowing it, is phenomenal. It really is phenomenal. And if you trust it, you're gonna find that you're able to do swing trades a lot easier because you're studying past back data. And as a kind of like inside note, tomorrow, which will be Saturday the 20th of April 2019, the teaching lesson will be how to do back testing and how to build a collection of data, so that way you can start building confidence around what you're trying to do in the charts. Because a lot of you have a lot of theory, you understand it, you're familiar with it because you heard me talk about it, but now we're going to start moving into what do you do with this information, start building out some practice sessions where you don't need me telling you to do each week. Here's a specific challenge. You'll know every day what you should be doing and how to collect that data and how is it useful. All right, so we have the down close candles in here. That's our bullish order block as well on the weekly. Then we have this candle right in here. See that? This down close candle is right before these equal highs. So yes, we could have been buying right on this candle here. And actually I have this already on another chart. Here's the dollar CAD, the market trading down into the order block here. This is the beginning of October. I'm going to take that out now so you won't need it. So when price moves away, we come down into the order block here. That is an opportunity to be a buyer. We can go long. What's the point of entry here? What's the target on it? What are we looking for? Well, we have two candles here on a weekly basis. This is an initial target. Why? Because these are equal highs. This up close candle and this down close candle, they're relative equal highs. When we drop down to a daily, it'll be more apparent. But we also still have these equal highs here. Okay? So you're going to need to watch this video a couple times because I'm going back and forth between several time frames. But I already warned you, April, we're going to get into a little bit more detail. And it's going to be harder for you to just watch the video one time and think you know it. You're going to have to chew on these lessons because it's a lot more things involved. Okay? You have to compare and contrast things. And that's why it's important for you to do this stuff in your own charts. But we have an area here that's relative equal highs, and this obviously is equal highs. No doubt about that. This down close candle, price trades down into it, hits it here, as this candle right here, this weekly open, trades down into this order block. Why this order block? Why not trade all the way down here? Because it already did that. Institutional order flows already started to show you the signatures are in place, but this order block has been capitalized, rallied up. Wait for a down close candle. We have one. Is it before or lower than our original draw on liquidity, which is the equal highs? Again, think about what was taught to you in model number 3's original presentation. When we have equal highs, okay, And we have a period of when the market is bullish, like we have here, the COT data, it's showing that. That's all occurring in here, right in here. It's just all bullish during that period. And I'll put the vertical lines on just for completeness sake. Okay, that's the end of September. And last day of December. So all of this period between these vertical blue lines, that's all when commercials are really, really bearish Canadian futures, which is bullish dollar CAD. Okay, so I'll leave these on here. And this is the weekly order block. Price trades down on this candle here on the 2nd of December. That's that weekly candle. So the week of December 2nd, that's when we're looking to enter to get a run on the equal highs. Again, the premise is it's a swing trade. We drop down into a daily. Here's that open. We trade down. Look at the candle here. Here's the 3rd of December. The 3rd of December, we trade into the order block. We could be a buyer here with the expectation of the equal highs as the upside draw. The low on this is 131.60, we'll call it. 131.59 is the low, but 131.60 is the actual 10 level. The draw on liquidity is 33.84. Because they're equal highs, then we know that it's likely going to sweep above that, right? So what does that mean? 133.85 is a draw on liquidity. So between 133.85 and 131.60, we have well over 100 pips, right? Several. We have over 200 pips available on this setup. So as a swing trader, buying here, where does your stop go? It has to be below this low right here. Okay, what is that low? The low is 131.26, so our stop has to be about 10 pips below 131.25 or 131.15. That would be here. There's your stop. Your target is above here. So how many days does it take to get there? Well, you're buying on this day. As it slams down in the order block, what's the price? Anything below these equal lows, you see that? Equal lows, liquidity's resting below that. It also tags the order block, trades in the order block here. Buying it, going long, stop goes here. Do you need to be in intraday charts to do that? No, because you can see the equal lows here. You can see this low here, and you have to be below that. Okay, so there's your stop. You can see these on the daily chart. Do you need to go into a lower time frame? No. It helps. It helps to do that, but you don't need to. Okay, so this model is for people that have that. It's the working man, working class hero model, where you have jobs, man. You have businesses. You have things that prevent you from being a intraday junkie. So if you can facilitate a trade using intraday concepts, it'll reduce this stop to something smaller. But we're not going to teach that here. I want you to focus on this level of perspective. Okay, just know that you can use all the intraday scalping and day trading model to complement this area in here to reduce the overall risk and not have this such a wide stop. And you can leverage more, but not open yourself up to larger risk. But we have over 200 pips available, and it's been offered over the span of 3 days. So this movement here, this is a classic swing trade. Doesn't take very much time to get there, over several hundred pips, but beautifully illustrated using everything that was taught to you in price action model number 3, original presentation. If we look at the 4-hour chart, which is something that you can do because it's still friendly. It doesn't allow for a lot of time pouring over the chart. It doesn't take much for someone that has a job or a business to just quickly open up a chart and see where we are on the 4-hour chart. And in here, when price was dropping down, we know there's an order block here. It trades into that. It does it again here. Then price starts to rally away. These down close candles in here, anywhere inside this range, you could be a buyer. And your stop would still be down here. Everything still is the same. They're close proximity entries. You learned about that in the mentorship. So you could see this open here when it was trading down again. Okay, you could feel confident that this run down, all this is doing is closing up a fair value gap. What's the gap? Well, we have this candle here, extended out in time. Price only draws up through it with buy-side delivery. It opens on this candle and then trades down. So as it was feeding back into this upside delivery on price, buy-side delivery creates a sell-side imbalance. This candle here opens, trades down, rebalances the sell side, and then after it does that, price is then allowed to move to the upside. What's it attacking? This level here, that 133.85 target. And look how fast price gets up there because it's seeking that liquidity. On a 4-hour, okay, on a 4-hour, we have equal candles here as well. Okay, that's a liquidity pool. That's a liquidity pool. Anything above equal highs or below equal lows is a liquidity pool. When we know they're that clear and that apparent, that's what a liquidity pool is to me. It's not going to a website and seeing where there's supposedly stops building up. I don't have any faith in that. They're not going to see those orders because orders are able to be pulled. In other words, removed from the marketplace. When you see old highs, old lows, okay, that's where liquidity is going to rest. It's obvious. It's classic, simple. You know where the stops are based on the chart, okay? And that's what I trade. I trade outside the chart. I'm looking at things outside of these candles above it, and I'm looking for things below the candles here that are outside the chart. There's nothing down here. But I know there is. It's liquidity. You know there is liquidity. The chart, no one's thinking about this area up here or the expansion of 10, 20, and 30 or 5, 10, and 15 pips above. Okay, that's how we internalize because we look at institutional order flow and pairing of orders. That's completely diametrically opposed to what as we learned when we first get into the marketplace as retail traders. What's this candlestick formation? Is it a doji? Is it a hanging man? Is it a dark cloud covering? It's nonsense. That's why none of that stuff works. So when we change our perspective and that model of market efficiency paradigm is acquired and now utilized in our analysis, we don't look at the marketplace as a retail trader. We look at as an institutional trader. Because as an institutional trader, we have to know where the counterparty liquidity is. Now, what I just said is completely the foundation to what makes me ICT. My perspective on price is diametrically opposed to what you're taught and what everyone else is doing in the retail scope. That's why my strike rate is high. That's why my accuracy is high, because I'm not doing what everyone else is doing. I'm not thinking like what everyone else is thinking, and I'm not teaching you to do that either. I'm telling you how to think like a predator. We're looking for the herd mentality. Okay? The herd mentality is going to be attacked. Not all the time. Sometimes the herd will be allowed to move like it does here. It's moving up. Well, it's moving up because it's supposed to. Now it's allowed to move that direction. But once it gets here, okay, once it gets above that, then our mindset says, okay, now I'm going to look for the sick cow. I want to see that sick wildebeest, okay, or that sick deer, or the one that's confused and doesn't know what it's supposed to do. It thinks, okay, well, the crowd's been going here, the herd's going higher, it wants to go further still. No, we attack that. We sell short in here, okay, or we sell our long positions that's been acquired down here. Why? Because the counterparty is above these highs and above this 33.85 level. Okay, so once this takes place, we expect the market to turn direction. we see that happening here. What's it doing? We have a buy side imbalance. Buy side imbalance, sell side inefficiency. Price comes down and rebalances it in here. What is it doing? It's giving an opportunity to build in more sentiment. It's interesting that we have a fair value gap in here. Not a large one, but it still comes down and rebalances that. Then what does it do? It has to come back up and rebalance this area here. Between this candle and this candle, it's a SIBI. Sell side imbalance, buy side inefficiency, which is rebalanced here. Then it creates these equal highs in here. All of this creates what? Another liquidity pool, right? Or equal highs. Everything that we just disclosed and talked about in this model here, if you are a short-term trader, the same thing applies for this area here. And I'm just tossing this in there because it's too good not to talk about. But we have a BISI here, buy side imbalance, sell side inefficiency, order block, which makes this order block, this down close candle, high probability. Why? We have equal highs, and then between this high and this high, we have a relative equal high. This is liquidity resting and building up here because they're going to be chasing this sharp move down. What's retail thinking? Oh, this is that 1, 2, 3 drive pattern. No, they're going to be seeing momentum divergences in all these highs. It's not there. Creates liquidity. They're going to be chasing this as a 1, 2, 3 top. Okay, all kinds of harmonic patterns. They're going to be screaming, saying, hello, this is a short. When price is dropping down, they're going to feel rewarded. They'll probably chase and buy, sell more of it, which builds a larger liquidity pool up here. This order block, when it trades there, you're a buyer. Shooting above here, that's our liquidity. It does it there. But then we start doing the expansions of 10, 20, and 30 pips above this highest high. The highest high would be 134.43. So we could go 134.73, which would be maybe reaching to 75. Okay, 34.75. And that would look like that's close enough. And it hits it here and sweeps it. And then we get that rejection and goes lower. What is it doing right there? It's coming back, filling in this BISI, buy side imbalance, sell side inefficiency, trades back down, hits the order block again. Why? Why is that an order block? Because we have an imbalance, we have institutional order flow calling for higher prices, and why this price here, 134.75? Remember, we had that longer term, higher time frame, 133.85 down here. Okay? If we go out to the weekly chart, we talked about this area right in here. Let me zoom in. We talked about this void right here. This is a SIBI. Sell side imbalance, buy side inefficiency. What's it going to want to do? It's going to want to fill that in. So I just gave you all of the ways we can use a 4-hour chart to get in sync with that larger price move and capture all of this run here. How many pips is that? Right in here, so there's equal highs going in around 33.85. Okay, consolidations around that old equal high area here, runs beautifully up into, and again, all during that time when the COT hedging program I showed you, again, this area here, bearish Canadian, bullish dollar CAD, expansion to the upside, this area right here. Go back and look at the charts, folks. I talked about this area right here, and it went right up to it. Filled it in. This is the reason why I said that, based on everything I'm showing you here. Well, wait a minute, Michael, why didn't you do a swing trade? I've already told you that's not how I trade personally. But I use that analysis, and that's how I do my weekly analysis with you. Now, looking at the chart right now, we have the opportunity, give me something right now, Michael. Right, and this is what we're going to do. We have down close candles, the market trades down into it, bullish order block, hits it, rallies away, but now look what's happening, we're consolidating. What's left here? What's in here? Is equal highs. This is on a weekly chart. Isn't this same thing right here, this? Yes, absolutely it is. So if we drop our horizontal line here on this candle here, we're going to be looking for 135.60, 135.65 in that area. Specifically, the candle's low is 35.63. We'll just round it to 60. $35.60. There we go. And now we can drop into a daily chart. Liquidity void, equal highs, runs above equal highs. It could expand up into, like we saw here, okay, all this movement here, it could see that run up into this area here. So 135.60, that's my target. I'm looking for $CAD to do that. Okay, what changes it? We lose this low here. Okay, we have equal lows. We've already swept that. Everything's looking like this thing wants to go higher, and now you can paper trade it. Okay, start looking for down close candles on the daily and 4-hour chart. Paper trade them as a long until we get above these equal highs and up to this level here. Okay, so hopefully you found this installment insightful. Hope it built your understanding about Model 3 a little bit more. If anything, it's giving you something else to study and go back and look at. And now you have something to go forward and forward test based on what I just shared with you here. Until I talk to you next time, I wish you good luck and good trading.